All right, sports fans. Uh, Today's conversation, as Connor said, is going to be about general liability, umbrella and excess, commercial auto, and workers' compensation. It is episode 3 in the Financial Poise Insurance series, Insurance for the Business Owner 101. And for information on Financial Poise, you can look at slide 40 in the deck. I'm not going to scroll through all the slides here for you. You guys can do that on your own time. Today, with me today, our panelists, we have Jonathan Mayotte of Thornton Powell. We have Lee Burke of Bogart and Brownell, and Dan Rawson of Origin Specialty. And I am Gary Kirschenbaum. I'm with the Lara Group, and I'll be moderating today. So, um, neither Financial Poise nor us, the panelists, intend for this to be any kind of an infomercial. So you won't have to listen to me read bios. If you want more information about us, again, you can refer to slides 32 through 37 in the slide deck. And then also with regard to the slides, don't worry if you're listening in but not necessarily watching the webinar. You'll be fine. The slides aren't actually critical to the conversation. It's an additional tool to enhance some of what we're talking about. But the goal here is to have a conversation. Um, Financial Poise is sponsored in part by the National Law Review. For more information, slide 3. And then the last thing before we begin, a little disclaimer. Um, you're not our clients. We're not your lawyers. What we're doing here today is really for general information and education and not for you to act on without appropriate advice. So without further ado, let's jump into it and let's have a conversation about, let's start with general liability. So Dan, I'll just pick from the panel. We'll kind of run back and forth in order. And then as you guys see fit, please add commentary or color. Dan, let's start with just what is general liability for business owners and their advisors?
Thanks, Gary. Yeah, general liability is really defined as the foundational insurance policy you have when you're running a business to help you protect you when things go wrong from negligence. So think about some core principles of general liability. It's bodily injury and property damage. So bodily injury would be a slip and fall. Somebody comes into your place of business, you're held to a standard of care to protect them. They slip and fall because the snow was not shoveled properly, the water was on the floor, or maybe they just slipped and fall through no fault of their own. But if you get sued, your general liability policy will indemnify and defend you for those types of losses. Similar to property damage, somebody comes on to your premises, say you've got a forklift operator that damages their vehicle, that would be property damage that they would suffer. And again, general liability does a great job of protecting you. So if there's a judgment or a claim that needs to be paid, it would pay those as well as provide defense. So most businesses would start with the basic general liability, and then there's some other coverages that extend. So personal and advertising injury would be libel and slander claims against you, which can be covered. And then general liability has a lot of different coverage extensions for things like product liability. So if somebody comes to your premises, maybe you're a restaurant and they get sick from your food, your product liability would cover that bodily injury to that person under your general liability. So it's really the foundational liability insurance that almost every business needs to be up and operating and protect them from unforeseen types of losses.
Got it. Uh, any comments, additional information, Lee, Jonathan?
Well, I think Dan did a good job.
Cool. What about backing into it? What doesn't it cover?
Yeah, so as I said, general liability is kind of the foundation, but there's other policies that any business owner that needs that has a certain exposures. So if you have employees, you need workers' compensation. If you have liquor liability, you're serving liquor, your general liability wouldn't necessarily cover that. If you're engaged in a profession, accounting, legal work, engineering, other things that you're held to a professional standard, those things wouldn't be covered under general liability. And then
Got it.
automobile liability, obviously you would need an auto policy. There are exceptions where sometimes certain companies will extend the general liability for vicarious liabilities of your employees doing things because you don't necessarily have direct control. But it's a starting point, and that's where we advise folks to work with their broker to identify those specific coverages, professional liability, auto liability, other coverages that may need to be added in addition to a general liability policy.
Okay, good. Thank you. Thank you. All right. And we'll be coming back to some of that a little bit later in the conversation to explore some of the things you brought up, Dan. But let's kind of get an overview of the other coverages we're going to talk about here. So, Lee, can you talk about umbrella coverage a little bit, what it does and how it differs from uh, excess liability coverage or surplus liability coverage? Is that like many things in insurance, lots of names for sometimes what are perceived to be the same things?
Well, we try to do our best to confuse people so that we as professionals look really smart and they need us.
Job well
Um,
done.
the, let's start with the excess liability and build on there. And I'll start off by saying that excess liability and umbrella policies are cousins in the same family, but they're different cousins. They're from different sides of the family, maybe. Excess liability coverage is a second layer of liability coverage that sits on top of your primary liability coverage. Now, I'm using the term liability coverage because it can be general liability, it can be automobile liability, it can be personal injury, it can be a variety of liability insurance. But you start with a primary layer of coverage, we'll call it a foundation, like a foundation in a building. And then excess liability is the second layer of coverage that provides higher limits or more coverage to protect against a serious claim. The excess liability policy, and you want to be careful to know whether you've got an excess policy or an umbrella, and I'll explain why. The excess liability policy typically provides the same coverage, no more, maybe less, but no more than the primary liability. And when I say no more, in terms of the breadth of the coverage, the type of coverage it provides.
Right.
So in the insurance world, we use the term following form. And the excess policy basically says if the primary policy covers it, we cover the claim. We'll provide a second layer of coverage, same type of coverage, following form, providing the same coverage, same exclusions as the primary policy. So it is just that second layer of coverage over the foundation. An umbrella policy does the same thing. It provides a second layer of coverage, just like the excess liability policy does. But the umbrella policy typically is not on a following form basis. It says we provide the second layer of coverage on top of the primary amount of coverage. We cover the types of claims that would be covered under the primary policies. We also cover a variety of claims that may be excluded or not covered by the primary policy. So the umbrella policy gives you added coverage or gives you liability coverage in a number of areas where you would not have coverage under your primary liability policy. Now, if you don't have the primary liability coverage, there's going to be a deductible, but you still have protection that you otherwise wouldn't have had. And
Does the does a umbrella and or excess policy always have a separate individual deductible?
the umbrella and the excess policies, if it is coverage, if it is something that is covered by the primary policy, the primary policy effectively serves as the deductible. So you have $1 million on your primary policy. let's say you have a $2 million excess policy. That $1 million on the primary policy is effectively the deductible under the primary policy. If for any reason you lapse the excess policy, you're now responsible for that first $1 million worth of coverage yourself. The excess will still pay the 2 million. On the umbrella policy, if there is no primary coverage, but the umbrella policy would drop down, as the term we use, to cover the claim, then there's going to be what's called a self-insured retention. And that self-insured retention, it's not going to be $1 million. It could be 10,000. It could be 50,000. It's going to be a meaningful number. But if it's a large claim, you're still going to have the coverage on the umbrella policy, whether it be $1 million, $5 million, $10 million coverage.
So just to explain for our audience, when you say drop down, you're referring to the umbrella policy picking up coverage where your primary did not.
Correct. Correct.
Okay.
Let me give you an example. General liability coverage would normally have a watercraft exclusion. It's not going to cover anything to do with watercraft. You
Right.
have a company and you charter a boat for a Christmas party. You take out your employees, you take out your best clients out on this boat. The boat catches on fire and everybody ends up in the Chicago River. Now you've got a liability claim. Your primary liability policy is not going to cover it because there's a watercraft exclusion. Your umbrella policy probably will cover it, but there's no primary coverage. So now the umbrella policy will drop down to that self-insured retention, again, typically maybe $10,000, and pick up the claims arising from that watercraft liability.
Yeah. Okay, good. Good. And so I'm speaking from a personal experience that's happened more than once over the years, where a client, neglects to or forgets to tell us that they've ventured into some new part of their business, whether it's distributing product that they weren't distributing before, delivering a service, or whatever it could be. But they've branched out and expanded their business and evolved. And, as the insurance folks, we're sometimes the last to know about these things. So, Jonathan, bringing you into the mix here. Um, can you talk a little bit about why it's so important that a business owner is notifying their insurance folks about what kind of operations they're delving into?
Absolutely. So the carrier needs to be aware of all the operations. Part of that's to determine pricing, part of it's to accurately assess the risk. For example, if a consultant is going to be rated just a little bit differently than, say, somebody who's a welder. If you're a consultant that decides to start taking on welding operations, then that totally changes the dynamic of what's being insured. Likewise, if your consultant's a little bit more, or it's a little less risk comparatively speaking to what a welder is going to be doing. So when it comes to the general liability, umbrella, excess, they need to know exactly what you're doing and what they're insuring and what they're covering so they can properly decide, first of all, whether or not they want to insure it, and then secondly, how much they need to charge to properly be able to cover claims that they may be assuming.
Cool. All right. So Jonathan, let's keep going here because I want to talking about operations, and Lee mentioned earlier product liability, or no, Dan, sorry, mentioned earlier product liability, sort of falling under that general liability coverages, third-party coverages. Can you talk a little bit about product liability versus product recall?
Sure. So product liability protects a business against claims of injury or damage caused to products that it makes, sells, distributes, or even repairs. And it's typically covered or typically covers caused bodily injury, caused property damage, design and manufacturing defects, inadequate instructions or labeling, things of that nature. So, I mean, even if your business only sells or distributes the product, there's potentially vicarious liability exposure that needs to be covered. Now,
Okay.
when it comes to product liability, or I'm sorry, product recall insurance, That's going to cover whether or not, or that's going to cover the costs associated with actually recalling the product. So it's going to be a little bit separate, a little bit different. That's not going to be covered under product liability insurance.
Got it. So inadequate instructions. So can I go back and sue IKEA for not being able to put my stuff together for my kid's college room?
I think there'd be a line out the door for those lawsuits.
All right, good. Dan or Lee, anything to add on? There was a whole lot of information dumped in that few minutes there.
Yeah, I guess I think there's a little bit of a misnomer on an umbrella. A lot of clients think, hey, I've got an umbrella, I'm covered. It's like not necessarily. So if you're getting into a new operation, call your broker and talk through what you're doing, because the umbrella is only going to be as good as what it's following. As Lee said, you've got non-owned watercraft, which is a little unique exposure, but there's not that much extension. So call your broker and have a conversation, and don't rest on the fact that, hey, I've got an umbrella that it will cover everything, and it won't necessarily. So talk to your agent.
Okay. And I'm going to talking to the audience for a moment because Dan, you bring up a good point, but and always talk to your broker about these things, but read your policies as a business owner. Take the 10 minutes to go through it and look at the back of the policy where the exclusions are. Because if it's excluded from the GL, it might be excluded from the umbrella, etc. Anyway, okay.
Two real quick things I just
Yeah.
wanted to add real quick. Number one, misconception that I get from a lot of people is that their personal umbrella will cover commercial things. They're
Oh,
totally separate. The other thing that I will have is people
interesting.
just reaching out saying, yeah, I just want an umbrella policy. Well, do you have any underline? No, I just want to start with the umbrella. Well, no, we'll get to that. We need to talk about the foundation first. We're not putting
Yeah.
the roof over the house without the foundation.
Yeah, that's a good point. That does come up once in a while, particularly with small and mid, like I'll say small lower middle market businesses sometimes not fully understanding the concept. So, all right, well, let's keep moving along here. We have an hour. We've used up a quarter of it, and the goal is to finish a little on the early side. So, intellectual property. Let's talk about that for a minute. Dan, if I'm not mistaken, I think you have a legal background too,
I do.
correct?
I do.
I'm sorry.
So yeah, we'll talk a little bit on two sides of the intellectual property. So there's two significant exposures. One is where you are making a product that would infringe on someone's patent. So you get sued and you'd have defense for your product because someone who owns a patent is alleging that you infringed on theirs. So that product is available depending on what your product is, and patent search, an underwriter will look at how much to charge you, how unique your product is, how much it differentiates from somebody else in the market. The other side of that is, say you own a patent that you're making a lot of money and it's really expensive to enforce that patent to others. So there's stories in the media of you've got this great invention, and then all of a sudden you go on Amazon and there's 10 other companies selling that. So you want to enforce that patent, and that can get very expensive. So there's insurance that you can buy as the owner of a patent that can help with those expenses to enforce that. So two sides of the coin, again, very specialized coverage, but very available, and can be, very helpful to safeguard the business's assets.
The first part of that, where you as the business owner, and again, I'll use a personal example of a client where they had a product line that they had actually acquired, and then shortly after acquiring it, received a lawsuit, a claim, um, because claiming that they stole the font.
Interesting.
Right, right. And the question of having coverage under the policy to defend and so forth. I mean, and my point is, it's something as simple as the font in their product, in their marketing materials, the packaging of the product.
Exactly. Or even just, we've seen the name of the business is too close to the name of somebody else's, and to be able to defend that, sometimes these specialized
McDowell's.
coverages. Exactly.
Well, coming to America reference. Okay. All right. Lee, Jonathan, anything to add? Any personal uh, experiences with clients that touch on some of this stuff?
I'll just simply say that I don't think there are very many clients that are aware that intellectual property liability coverage exists. Um, it's surprising, but it is not a well-known coverage. And again, both from, as Dan said, from the offensive and defensive side of the ball, there's two different aspects of it.
Yeah.
Um, and it's very important. It's important for people to realize that they do have a lot of companies have very, very valuable intangible assets, and they just don't think of them. I mean, this is
Right.
this is where risk management differs from insurance. Whereas risk managers, we sit down and talk to clients about and point out the assets that they have, and those intangible assets, if they're lost, if they're damaged, it can sink a company.
Yeah, no, 100%. And it's a good point. It's some companies have IP, know it's valuable and don't necessarily understand or know how to protect it. And then the other side of that, like the client that I was referring to with the font case, similar situation where a client posted some stuff on their website that didn't actually belong to them. They
Mm.
co-opted some pictures and they ran into the same problem because now you're using other people's IP. And again, these are all things that can be protected as long as you're not being nefarious about it.
You know, Gary, let me just jump into one other thing. A lot
Yeah,
of the people that'll be watching this seminar are going to be accountants and attorneys. From an accounting standpoint, the accountants are issuing financial statements. The financial statements have footnotes. Um, how important is it for that accountant to look at a client and ascertain if that client does have substantial value in intellectual property assets? And if those assets have a risk and they're not insured, should that be a footnote on a financial statement? I mean, I would think it would be. If I was a lender, I don't want to know that information.
right.
If I was an investor, I'd want to know that information. And likewise, if you're the legal counsel for that client, you should be addressing with the client the legalities and the risk issues and discussing it with them that exist with those intangible assets.
Yeah. Okay. Well, Lee, let's keep moving on with you here because let's jump to a new coverage. Let's talk about commercial auto. What does it, it may sound pretty obvious, but what does it cover? But how does it differ from personal auto and other lines of coverage?
Okay. Well, automobile insurance, whether it be commercial or personal, really simple. It's going to cover your rolling stock. It's going to cover the trucks, the buses, the trailers, some of the mobile equipment, et cetera, et cetera. If it's self-propelled, and it's on if it's on wheel or in many cases tracks, it's going to need to be covered under an automobile policy. Now, whether it's commercial or personal comes down to who owns the vehicle or the mechanical item. If it's owned individually, then typically it would be insured individually. Now, it may be insured with a business use classification, meaning that it can be used in business. The insurance company will charge you a little more money, and that's perfectly fine. You've got an automobile, you use it in business, you insure it in your name, and and you pay a little more premium because you use it in business. If it's owned by a corporation, an LLC, a partnership, or a joint venture, then it typically is going to be insured on a commercial automobile policy, which provides much of the similar coverage that a personal automobile policy would. It's going to provide liability insurance, bodily injury, and property damage, just like Dan discussed on the general liability. And it's going to provide or give the option for physical damage coverage. So it's damage to the actual mobile piece of equipment, vehicle, trailer, bus, truck, whatever. That physical damage coverage, whether it be for collision or comprehensive, which would be non-collision type claims, your fire, your theft, your vandalism, your flood. Some of the difference between a commercial automobile policy and a personal automobile policy is that the personal automobile policy is written in the name of the individual. And for the most part, it's going to cover the individual when they're using that vehicle or other vehicles. It's going to follow them because the policy is in their name.
So, a lot of the small businesses, lower middle market businesses that we see, and even more so these days, don't have vehicles in them. They don't have trucks. They're not doing deliveries.
Yeah.
A lot of technology businesses where, you know, they've got sales going on, salespeople running around and that's it. And they're running around in their own personal vehicles. So again, business doesn't own any vehicles. Do they still need to have a commercial policy?
If they've got vehicles that are being used on their behalf, they're going to have a vicarious liability for the use of that vehicle. The vehicle is being used on their behalf in the conduct of their business. If there's an accident, somebody's injured, they certainly can be named in a suit. Whether they're going to be found to be legally liable is a different issue, but they can be named in a suit, have defense costs, etc. So we cover that. We provide insurance for that by use of what is called a non-owned and a hired automobile liability policy. A non-owned vehicle policy being basically you've got liability coverage for a vehicle that you don't own, but it's used on your behalf. A hired automobile policy would be a leased vehicle of some type or a rented vehicle of some type that is used on your behalf. So you're on a business trip, you lease a vehicle for Avis, Hertz, wherever. You've got coverage for that.
So if I have
The
that,
other, go
oh,
ahead.
go ahead. I'm sorry.
No, I was going to say the other thing that people don't think of is that if you've got an employee that you're reimbursing them for the use of their vehicle, whether it's on a mileage basis, per diem, per month, etc., even just buying them gas, that technically becomes a hired vehicle because you are paying something for the use of that vehicle. And almost everybody's got, they've got employees that are running to the bank, going to the hardware store, going to the post office. Some people are using their vehicles on your behalf in business.
Yeah, the hired and non-owned, it should be in every policy.
Yes.
Yeah. So, okay, cool. Thank you. Oh, and just to always try and close the loop on these different lines of coverage, Dan, Jonathan.
I think you got it.
Yeah.
Great
Okay,
description.
cool. All right, Jonathan. Next line of coverage that we're talking about today here. Workers' compensation. Who does it cover? What are the big things business owners should be aware of when it comes to this particular line of coverage?
Sure. So workers' comp is going to protect a business and its employees in the event of a work-related injury, illness. In almost every state, with the exception, I believe, of just Texas, it's workers' comp is mandated, so you have to have it.
Yeah,
Policy covers employees, certain contractors or subcontractors if required by law. The laws are different state by state. For medical care from job-related injuries or illness, wage replacement, disability benefits, rehabilitation costs, and also death benefits for dependents of employees that are killed on the job. Owners and corporate officers do have the option in most states to be able to opt out of coverage. Big things to keep in mind. Again, mentioned before, it's mandated by the state. You're legally obligated to carry it unless you're in Texas. And even if you are in Texas, I would say you should probably have it. Employees are classified and rated based on the type of work that they perform. So that's how they're going to determine the rate. If you're up on a roof banging a hammer, there's a lot more risk there. They're going to rate that higher than, say, somebody that's sitting at a computer for 8 hours a day. Policies are audited every year to determine the actual payroll. So up front, you're going to estimate on most policies what your premium's going to, or what your payroll is going to be. So say you guess that, yeah, we're going to have 100,000 in payroll. And then they do the audit and they say, well, you actually had $50,000 in payroll. The insurance carrier is going to cut you a check for a refund. Now, if it turns out you had 500,000 in payroll and you only reported 100,000, you're going to owe the insurance carrier some money. So the idea is you want to get that as close to accurate as possible. Make sure that all your injuries are reported promptly. That's a big thing to keep in mind. If you have safety programs and clean claims history, that's going to help kind of bring the cost of the workers' comp down for businesses. Some states have contractors credits. There's a lot of different little things that you can try to do to bring your overall costs down on the workers' comp.
Okay. Work comp is one of those things that's at face value is very simple and straightforward, but when you start diving into it, a lot of complexities and nuances. Um, Lee or Dan, I would say anything to add, including how a business owner or an advisor to a business can lean on someone like Jonathan or Lee or myself uh,
Yeah,
in
I,
terms
I,
of those audits and how to apply work comp.
yeah, I'd add a couple things. Audits. I think Jonathan did a great job. We've seen clients that say, "Hey, I'm a landscaper," and actually they're doing underground trenching work, which is a lot riskier. And so on the audit, the carrier is going to come in and actually find out what they do, and companies can get penalized. So it's not worth trying to save some dollars because it will come back. The other thing that Jonathan mentioned is work comp is experience rated just based on your own typically loss frequency and some severity. So if you as an employer do a really good job of safety and keeping things, the best work habits and not having injured workers, you're going to pay less than your competitors. So there's a baseline that everybody in the industry pays. If you're better than the baseline, you're going to be paying less. If you're worse, you're going to be paying more. So there's a very direct correlation in work comp costs to your loss experience. It's very much worthwhile investing in the risk management in the business.
Well said.
Yeah, I'd
Okay.
add two things, and Jonathan and Dan did a really good job. Um, you, there are agents that are knowledgeable in workers' compensation, and then there are the bulk of agents really kind of treat workers' comp as somewhat of a non-competitive item. They basically say, okay, the state law says you've got to have it. In lots of
Mhm.
states, Florida being one of them, the rates are the same. They're regulated by the state, and agents tend to treat it almost as a throw-in and don't pay much attention to it. And if you paying a substantial amount of premium for workers' comp and you're not dealing with a knowledgeable workers' compensation professional, you are probably costing yourself a lot of money because there are lots of things that a good agent or a good broker can do to help you save money. Just one example is that it is very common for employees to function during the course of a week in different job classifications. Take carpentry. There's like two different dozen different workers' compensation class code for carpenter. You've got trim carpenters. You've got people working on trusses. You got finish carpenters.
Right,
Um,
right,
each one has a different comp code and a different rate. So if you've got a carpenter that's moving between those class codes, the agent, you say to the client, look, keep your payroll records separate so you're paying them according to the work they're doing. And that
right,
you're paying your workers' compensation according to that individual rate. Because when the auditor comes in, if you don't have the payroll recorded separately, they're going to charge the entire payroll at the highest rate.
right, right,
So, now you're paying thousands of dollars more for that employee than you need to. The other item, and Jonathan touched base on this, that in most states, owners, officers can exclude themselves. Be very, very careful when you exclude themselves because the typical individual health insurance policy or group health policy is probably going to have an exclusion on it.
right,
And the wording will vary, but it generally is going to say something simple like, this is a health insurance policy. We do not intend, nor do we want, nor are we going to pay any claims that are arising out of your employment. The
right.
health insurance carrier does not intend nor want to pay workers' compensation claims under that health insurance policy.
Yep. We get into that a lot when owners want to take themselves off because they don't want to pay the extra premium because they have a healthcare policy.
Yep.
And the reality is most healthcare policies, like you said, exclude it, work comp claims, and it's a couple $100.
Yeah.
And by the way, it's a good way to not impact your healthcare program because
Yeah.
that's going to go up more than your workers' comp is. But anyway, uh, I want to keep moving along, and I don't want anybody to think I'm going off book here because cyber is not part of this panel. But I want to ask a question. I'll ask it of you, Dan. Cyber insurance, which is a relatively new coverage in the grand scheme of the insurance world. because insurance has been around for so long. But um, again, some personal experiences where I have a lot of clients that say they have cyber coverage and it's in one of their other lines, typically property, which is not
Mhm.
part of this. But can you just touch on, why it's so important and could it be covered in any of these other policies and what would the difference be?
Sure. So let's talk about cyber in two ways, similar to intellectual property. There's cyber damage that happens to your own company's business property. So you get a cyber attack, your computers are shut down, you've got loss of business income. That may be covered in your property insurance policy or may have a sublimit, or you could buy a separate policy. Contrast that to you have private information, whether it's protected personal information, healthcare information, somebody gets into your servers, steals that information, puts it in the public domain. Now you're liable to third parties for cyber. So contrast first party cyber with third party cyber. The third party cyber typically is not covered by general liability. There's a cyber exclusions for that, so you need a specialized cyber policy. Then there's claims that are kind of in the middle, and I'll give you an example. Let's say, and this is real life. Say I am a provider of services, and I send my customer who's buying my services email instructions to wire me money, and that wire is $1 million, and that wire somehow by the bad actor gets intercepted, and they change the banking information. So your customer wires that money to the bank that was changed. You never get the money. It's kind of a jump ball. Who's responsible?
Right.
Were you responsible because the bad actor hacked the email? Well, did they hack your email or did they hack your customer's email? Should your
Yeah, but
bank have known? Should the receiving bank have known? So that's why it's great to have cyber, because the law is very unclear of who's responsible, and making sure you have cyber insurance to cover scenarios like that can happen. I had a customer that had an email in the last month hijacked his $13 million wire that got redirected.
yeah,
So
yeah,
it's out there and it's really significant.
yeah. Okay. Thank you. And that was exactly the point I wanted made. So appreciate that. It does happen all too often. All right, jumping back to the topic of the conversation. So general liability, and this is a constant question I think all agents are asked at some point. Lee, how am I supposed to know how much I need? How much coverage do I need in my general liability or my auto policies, my umbrella policies? How do I figure that out?
Gary, how high is up?
Well, I not very, because I don't want to spend a lot of money.
Okay. Um, this could be a 6 hour conversation and we wouldn't get to a definitive answer.
Right.
Um, I'll start off by saying I think there are two concepts we need to think about first, and they both begin with the letter R. And the first thing is what is required in this day and age of doing business. Any business is going to find that they are required by virtue of contracts, by virtue of agreements, by virtue of industry standards, et cetera, et cetera. They're required to maintain certain limits of insurance. You can't sign a lease without that. You can't do business with Amazon without that. You basically can't function in this day and age without having certain liability insurance requirements posed on you by lenders, by customers, by by employees, by union agreements, you name it, just go right down the line. So the first thing to do, and the first conversation that we all have with our clients, I know, is what are your requirements? I mean, who are you doing business with? Where are you leasing? Let's look at
Right.
the lease. Let's look at your contracts. And if the lease says you've got to have $5 million coverage, well, unless you want to be in violation of it, you got to have $5 million for the coverage.
Right.
So
What's the other R?
the other R is reasonably expected. what is reasonably expected. And let's just say, you know, let's say you're on a board of trustees of your church, your synagogue, your school, a nonprofit, your country club, whatever the case may be. I mean, most successful business people are on some type of board somewhere. Well, okay, what is prudently, reasonably required of that organization that you are a board member of, which you now have personal liability as a board member, or you're an officer of the corporation? What is reasonably required for that business to operate safely? Because if there's a claim and the business is underinsured, that claim may come back and bite you in the tuchus, because you're on the board setting the decisions and the policies of that business. So what are reasonable standards? And I think more than trying to determine, you know, just how much you want to pay or how much you can afford, we have to look at those two external factors to determine.
Right.
You know, we all have a situation where we have clients that have started businesses. And when you start a business, capital is thin. So people are trying to control costs, and we all respect that. We try to work with them. But then when we say to the clients, who are you going to do business with? Who do you want to go pitch your product to? And again, the client says, well, I'm looking to sell on Amazon. Well, you're going to look and sell on Amazon, you better factor in you're going to have $5 million worth of liability coverage. And
Right.
Amazon's they're not going to negotiate that. Walmart's
Right.
not going to negotiate. You're gonna jump to their hoop.
Yeah. Dan, Jonathan?
Couldn't have said it better myself.
Yeah, I think it's a great point. You know, the hot topic right now in insurance is nuclear verdicts, and
Yeah.
it's very, very difficult to say, all right, there's a $90 million trucking accident judgment, and you know, are those going to really stand? But certainly, it's coming more into vogue. I think, you know, when I talk to reinsurers, $1 million claims are now $2 million claims. So inflation is definitely impacting things.
Right.
So yeah, I think Lee's two R's are really a great guidepost.
Yeah. And I think you said something important. We're seeing more and more that customers and suppliers are making demands of higher limits to do business. And in the past, we would almost always guide clients to push back. If it's an unreasonable amount, push back and see. And to your point, Lee, most of the time it's somebody just checking a box and it's not going to go anywhere, but at least try. And recently in the last year or two, we've seen clients and even ourselves saying more often, well, maybe it's not a bad idea, because we're seeing claims that are just, they're starting to hit umbrellas and things that we hadn't seen in the past because of social inflation and general inflation, both. Yeah. Okay, so uh, here we go. Jonathan, every business has contracts. I can't really think of a situation where a business would actually be in business without some kind of contracts. And there's obligations in those contracts. How does that play into these liability policies that we're talking about?
So liability policies are going to cover the named insured's legal liability for typically bodily injury or property damage. And contracts like leases, construction agreements, vendor contracts, those typically have some extra obligations that are imposed on insureds, even if they wouldn't otherwise be legally liable. That would be considered contractual liabilities. So an example would be if a tenant signs a lease and agrees to be responsible for any injury occurring anywhere on the landlord's premises, even if it's caused by the landlord's negligence, but they signed that, they agreed to it. Many policies are going to have limits and exclusions on that contractual liability, so it's important to make sure that you know what the exclusions are, figure out what the buyback options are, so you can make sure that you're compliant with what's being required of the lease. Now, in that example, I think I would not be signing that lease if it were me. I would say I'm responsible for what I'm at my premises, but anything beyond that, no. Just my personal 2 cents on that. But Other examples would include landlords requiring to be listed as additional insureds on a tenant's policy, general contractors requiring subcontractors to list the GC as the additional insured, ensuring that tenants or subcontractors have equal or greater limits on the policies. Now, the big thing that we always tell our clients, excuse me, I'm sure Dan, Gary, and Lee, you guys do the same thing. And Lee, actually, I heard you mention it. Make sure the agent has a copy of the contract so we can review the insurance requirements and then try to match up those requirements with your policy. Make sure that there's no gaps in coverage, no exclusions, and so on.
Got it. That's a lot. And the whole concept of risk transfer, right? Lee, I know you talk about this a lot. Dan, especially with your legal background, I imagine it comes into play a lot. Any advice, any insight for business owners and other folks in the audience when they're having to look at these contracts that they're signing and understanding what they're really taking on?
Yeah, I think be mindful. We work with a lot of small subcontractors that want to get on big jobs. And the general contractors want to do everything in their power to push liability down to those subs. So we've seen situations where somebody's a carpet installer and there's a construction defect for a bad foundation, and that carpet installer gets named, and they've got to defend the general because the insurance and the indemnity provisions were so broad. So indemnifying somebody or adding somebody for additional insured directly for your work product, that's one thing, but completed operations for the entire project can really creep scope. So those are things to be very mindful of. Insurance underwriters will look at that, obviously talk to your agent, and then push back on the contracts.
Well
I think
said.
the other thing to be aware of for the layperson, Gary, is that there is a tremendous difference between a transactional insurance agent. And there are a lot of wonderful, honest insurance agents around the country who do a great job of selling insurance and taking care of everyday, I'm just going to call it everyday insurance needs. And then there are a handful of agents in most communities that are risk oriented and really risk managers, and will have risk management type of discussions with clients and be addressing many of the things that we're talking about today that are not just insurance oriented, but they're dealing with risk issues and how to manage those by reviewing leases and negotiating leases, contracts, et cetera, et cetera. And if you've got a business that's got any complexity, any value, any sophistication to it, you probably want to be dealing with somebody that has got a fundamental knowledge of risk management. And it's really simple. Go in and, if you interview an agent, just as you would if you were going to have brain surgery, you'd be checking out the credentials of that doctor. If you were going to negotiate an international contract, you'd be checking out the credentials of that attorney. Go interview an agent and just listen and see whether they're asking you questions and discussing transactional items just to get information to sell a policy, or if they're having an intelligent risk conversation. If you don't walk out of the office saying to yourself, "Wow, that was an interesting conversation," then you probably need to go walk into a different place.
Yep, good point. So I talk to a lot of business owners, a lot of very large businesses, a lot of mid-size, and a lot of small businesses. And I find that the conversation around risk management has more teeth, if you will, when I'm talking to larger and upper middle market type businesses. And I find that when I'm talking to smaller businesses, there's a sense of we don't have to worry about that stuff. So, really, at what point does a business owner, whether it's a sole practitioner, consultant, or outsourced CFO type, or somebody who's opened a retail store, where does it become important to start applying all the things that we're talking about, but really when we start talking about this risk management, this risk transfer concept, and what's in the contracts?
Personally, I think a lot of it depends on the item that you're talking about. And that a lot of that comes down to the individual. And I'll just give you an example. It's not unusual. We all walk into businesses nowadays and we see people who have brought their pets in the business. Okay. As a risk manager, I'm not a real fan of pet in the business, although I will tell you that we've got an employee that's got a mini dachshund, and it's a puppy, and he's bringing it into the office every day, and we all love playing with it. So I'm not I'm a little flexible. But when you walk into a retail business and somebody's got their pet pit bull, or Doberman, or Rottweiler, that is behind the counter, if that's my client, or my prospective client, we're having a conversation about that, and the client says, I go anywhere where Snarls goes everywhere I go, and they don't want to listen to me. I'm probably walking out the door and telling them, that I can't help them.
Right.
So there's a professional responsibility to tell people what they need to hear, not what they want to hear.
Yeah.
And that means lots of times you just have to walk away from a client. You give them the best advice and say, hey, look, I've got a standing rule. If somebody doesn't want to follow my advice, I don't need them as a client.
Yeah.
Now,
Okay.
they don't, I'm not Moses with the burning bush, but I don't want to waste my time either.
Right. Well, so Dan, Jonathan, anything further on risk transfer and when it becomes relevant or when it's something that really should be paid attention to?
I think it's just really important to have a conversation with your agent, or the agent have a conversation with their client, because you talk about a fractional CFO. It's like, all right, how were you safeguarding those files? Is that on your laptop at the airport, or do you have encryption? And just simple things. I had a company I was talking to, and they said, well, I've got a firearms exclusion on my general liability policy, and I've got security guards. I said, well, why don't you subcontract out your security guards, so it goes on the security guards policy, and then you get indemnified from the security company. And again, there's other ways of risk transfer besides insurance. So having that conversation, understanding what those exposures are, really can help the client in the long run.
Got it.
I think, I mean, every business has exposure, and it's all about mitigating the risk of that exposure. And some businesses have more risk than others, but definitely it's worth a conversation for everybody. And Lee, to piggyback off having the dog on site, I actually had a client who had a couple of, he thought they were nice little puppies, but they were German Shepherd pen
Yeah.
to guard the property. The insurance carrier obviously said, get those dogs out of here, otherwise we're no longer insuring this. And he said, oh, they're so nice. I said, well, they don't sound very nice because they were just barking at me as barking up. He said, well, we haven't had any theft issues since we put them in. I said, I'm sure. Have you had any issues with anybody climbing the fence and getting eaten?
And Gary, you made a good point, Jonathan. That's a great point. Gary made a good point before about reading a policy. The public would be amazed at how many commercial and personal liability policies in your homeowner's policy today have animal exclusions in them. That
Right.
is getting very, very, very common.
Yeah. Yeah. Well said. All right. There's a few minutes left. Um, Last question, and we'll wrap up here. Jonathan, I'll throw this to you. There's a term that gets thrown around, called tail coverage. And you just talk a little bit about what it is and where it applies so that we can get, kind of clarify for the audience when they should be talking about this.
Sure. So technical term for tail coverage is typically extended reporting period, or ERP. It's going to allow a business to report claims after a claims made liability policy ends. Now, there's occurrence-based policies and there's claims made policies. An occurrence-based policy would be typically your general liability policy. If you cancel it at the end of the policy term and somebody comes back a couple of years later and tries to file a claim for something that occurred while you had that policy is still going to cover it and pick it up. Now, if you have a claims made policy, once the policy is no longer in effect, all coverage ceases unless you have the tail coverage, or ERP coverage as it's known. It's going to cover claims for incidents that happen during the policy period. The way that they typically do it, you can get tails in increments of 12, 24, 36 months, sometimes longer, depending on what's required and the carrier and their abilities. They'll normally price that based on a percentage of the expiring premium, anywhere between 100 and 300%. They're going to want all that premium up front, so it's certainly not a cheap proposition. But it's important if you're a business that's, say, selling, you're closing, you're merging, you're a retiring professional like an attorney or a doctor, since most malpractice policies and professional liability policies are written on a claims made basis. If you're switching insurers, you need to make sure that at minimum your retroactive date is going to be lining up. Otherwise, you could have a big problem. If that's not possible, you need to make sure that there is ERP coverage available. If you're terminating contracts,
just to clarify, because so the audience, retroactive date referring to
when the date when the initial policy was put into place. So say you put a policy in place today, and then 3 years from now you decide to switch carriers, they're going to ask what's your retroactive date, and it would be today's date.
It would be normal for a carrier to pick up your retroactive date if you're moving your business to them. But so what you're saying is if you found yourself in a position with a claims made policy where that wasn't going to happen for some reason, like maybe there's a gap in coverage or something, whatever the case might be, this would be an example of where a tail would maybe be important.
Absolutely. Yes.
Okay. Dan, Lee?
I think Jonathan covered it well.
Yeah, definitely.
Excellent. Then, with just a couple of minutes to spare, I'll call it here for the end of this conversation, episode 3 of Business Insurance 101. And panelists, Dan, Jonathan, Lee, I really appreciate your time. Thank you very much. And thank you to Financial Poise. For those of you out there that want more information on Financial Poise, check out www.financialpoise.com. And we'll see you all again another time. Thank you.
Thank you.
Thank you, Gary. Good job.